You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Hey, welcome to Talking Real Money. I'm Tom Cock. Don McDonald has the day off. He had a little, how do we say this, procedure yesterday. He can tell you more if he wants, but he is not available. I'm here. I have a guest with me and just talk to in just a couple minutes, but you're out there trying to figure out what to do with your money. Our job is to help make that easier, less stressful, and kind of put money in its place. So here's how this all works. This is a live call-in radio program. Yeah, one of those actually where you can talk to the host. And in this case, we'll have another host in just a moment. But here's a way that works. Here's the phone number, 855-935-8255, 855-935-8255. I think it's 935-TALK. So, we've got some topics. We've got some questions. But you always go to the top. So call us, ask us your questions, anything money related. Yeah, we spend more time on investing. And today it turned out, surprisingly, shockingly, that, the bigger news day than we had expected, because Warren Buffett, who's viewed by many as the greatest investor, certainly of the last 60 years, has decided to hang up his, adding machine, I guess, his, trading tape at the end of 2025 and hand over Berkshire Hathaway to a guy named Greg Abel. What all that will mean to Berkshire Hathaway is up in the air, but I think there's some lessons we could all learn from Warren's outstanding efforts at running Berkshire Hathaway, which, wow. I mean, the returns. Yeah, he's bested the S&P 500 by a wide margin. And it's not a fair comparison, by the way, because the S&P 500 is 500 basically of the largest U.S. stocks. Warren has been what we call a value investor, buying companies that are out of favor, working on those companies, right? He's had the opportunity to get in and make some changes. I think once he does, he sort of lets them run. But he built that portfolio in a way that would not be index similar. Some of the companies you, of course, know, Seas and railroads and Geico, of course, right? Dairy Queen, Apple. He has a big holding in Apple, American Express. But guess what? One of his huge holdings is right now is cash, $350 billion in cash. And to quote Warren, just haven't found any right opportunities to run out and buy anything right now that he had to buy. So a couple of things I think you can take away, though, from Warren Buffett, who has done such a spectacular job as an investor, as a guy who's built a wonderful firm, Berkshire Hathaway. First of all, value stocks, those things that are out of favor, those companies that are not doing well, those companies that have products that people don't want to buy, or a lousy CEO, or for whatever reason the market has not loved recently. Well, those have paid off, right? Buying things that are beaten down and waiting, riding them back up, and in Warren's case, sort of rebuilding the business. That way to invest has worked. And this is something we have talked about for 25 years, maybe more like 30, that you need to hold a portfolio that holds all these stocks. Most of you don't hold value stocks because the S&P 500, which is where most people have a predominant amount of their money, is really basically kind of growth companies. The more solid ones are creating dividends, et cetera, et cetera. So that's one thing I think you could take away from Warren Buffett's great work at Berkshire Hathaway. Another is you need to know your appetite for risk, because Warren has been very careful with the people invested in his fund and told them there will be times when the market goes up. There will be times when the market goes down. If you do not like that, if you don't like seeing your portfolio decline by 20, 25, 30%, then you really should not be invested in stocks, because stocks are bets on companies. And some days companies look great and some days they look lousy. So you really need to know how much risk you're willing to take before you invest in anything. But I think the biggest takeaway from Warren, which I don't think will get a whole lot of attention today on the day that he's decided to sort of announce that he will be leaving at the end of the year, is how you really should invest. Because most people are going to say, well, I'll just put it all in Berkshire Hathaway. And Warren would not advise that today. In fact, he has said publicly that really the right thing to do is to buy an index fund, sort of tune out the noise. Don't worry about what's going on in the world. Keep investing in it. Let that grow for you, and your life will probably turn out pretty doggone well. So best to Warren Buffett, and we're looking forward to hearing from you. 855-935-8255. Right back with our other host in just a moment here on Talking Real Money.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to Talking Real Money. Tom here, Don off today. You out there trying to figure out what the heck do I do with my money, especially since at the end of the year we'll no longer be able to invest with Warren Buffett. Well, you can actually still buy into some of his ideas, but he won't be the one handling all the money day to day at Berkshire Hathaway. That will fall to a guy named Greg Abel. Well, guess we'll find out just how able Greg is. So we've got time for your questions regarding anything money related. And here is the phone number. It's 855-935-TALK. That's 855-935-8255. Now, you've heard this woman before on the podcast many times. She's never come in to do the live radio show. So this is a bit of a new thing for her. It's nice of her to take Saturday off from mowing her lawn. Since she just bought a house and she'd be spending it, trying to clean everything up. Roxy Butner, thank you for being part of Talking Real Money today.
How exciting to be on the live radio. This will be fun.
Thank you. Thank you. We got tons of questions, but we'd prefer to get yours live. But we did get one from Bill. I'll read this one. And he had listened a couple weeks ago and said, can you remind us of the YouTube program you mentioned last weekend? So there is a movie on YouTube called Tune Out the Noise. Have you seen it?
I did. It's great. It's wonderful.
And this is about dimensional fund advisors and David Booth. It was done by a guy named Earl Morris, who's a terrific documentarian. And it's now free. There's over 5 million views of that movie so far on YouTube. It's nuts. So if you just go to YouTube and type in Tune Out the Noise, you learn, I think, about the motivation of Wall Street and the way they've treated all of us over the years and how you can avoid getting sucked up in that. It's a pretty telling piece. And this tells the story of these academics who came along and said, wait, let's use the real numbers. Let's look at real research here and build mutual funds with that in mind instead of the latest idea. So it's pretty good.
Yeah, it was a great watch. And it's only an hour or so, I think. So.
Yeah, maybe an hour and a half, something like that. So it's available. It's free. Go to YouTube, type in Tune Out the Noise, Bill, and you can enjoy that. Now, many of you are shy and you don't want to be on the show, so you write us, which is fine. You go to TalkingRealMoney.com, click on Ask a Question, I think it is. I'll have to look that up. Don always does that part of the show. And then you write the questions. We get a lot of those, and we have a whole bunch. Should we take one now? Since we don't have a call? Why not?
Let's do it. So we have, let's see what the first one here is from Ben in Milwaukee, Wisconsin. Hey guys, many podcasts often talk about the power of compound interest, but we generally do not hear many live examples. Both my wife and I are 35. In our early years together, we worked our hardest to live off one salary while investing the other. The idea was to set a baseline, allowing one of us to take time away from work and focus on our kids. Today, even with the markets going the direction they have in 2025, we have over $450,000 in retirement accounts alone. With our age, we are 100% in stocks, specifically mutual funds, spread between large cap, small, domestic, and international. When I run through scenarios using a compound interest calculator, I run it at a 7% rate, which I believe is conservative with our portfolio, and assume we put in $1,400 a month for the next 20 years. With that in mind, the model projects I will have just over $2.5 million when we turn 55. If I were to stop adding in money, it predicts we'll have about $1.8 million. The question is, would you change the rate assumption if you were in our shoes? This may help set the stage for any investor. The power of time can help you accomplish your long-term goals.
Wow, that's a great question. By the way, I had it wrong. If you go to talkingrealmoney.com and click on Contact Us, it goes to a page you can bring up the form. You can send us a question. So, should I use 10%? Because that's been kind of the long-term return of stock. Should I use 7% to be safer? Should I realize that as I get closer to retirement, I'm probably not going to be 100% in stocks because that could create a lot of volatility as we've seen this spring. My answer would probably be to do maybe one at 9, one at 7, and one at 5, just to give you kind of a variance to see how things will look like. Now, I know when we do this, you're one of our financial planners extraordinaire, and we actually run 1,000, Monte Carlo kind of thing, right? To give you a better spread of what could be great, could be horrible, right?
Yeah, absolutely. The 7% rate can be kind of the average for that 50th percentile in the Monte Carlo, which is pretty good for kind of a 60-40, 70-30 portfolio. And maybe if eventually you think you'll get to that point when you retire and then run it at, that for the next 30 years, I think 7% is a good conservative average. But like Tom said, the Monte Carlo is the best way that you can really figure, what if there's different sequences of returns over the next 50 years? What if there's, long periods of recessionary periods? So, but yeah, 7% I think is fine. If you don't have access to the Monte Carlo, I think run it at a few different ones and gives you a baseline to be able to plan for worst case scenario.
Now, here's what Ben didn't tell us. He said that he's putting away, I think he said $1,400 a month for the next 20 years, which is awesome. He did not tell us what percentage of his income that was because maybe he's uncomfortable with that, or maybe it's too much, too little, etc. I probably, instead of doing it this way, would say, look, I'm going to do 15%. I'm going to set aside 15%, hell or high water, pardon me. And my employer is going to give me whatever 3-4%. So now I'm starting to get close to that 20, because I think at 20, if you do it regularly and you invest it properly, and I don't think you have to be all in stocks, the odds are probably in your favor of having a decent retirement in that early range. 55 sounds early to me, maybe because I'm older than that, but, and I like the work. I have no interest in really kind of doing that traditional retirement, but I'd rather see it, look at it that way. Say, look, how do I squeeze? And it gets harder, right? You've got homes and kids and all these other things that come into your life that sometimes can change that savings rate, and sometimes mean you may have to actually, we've seen cases where people have to spend it.
Yeah. At age 35, it's impossible to tell exactly what you're going to need. But I think their mentality, I'd like to see this more often, where one salary they live off of and they invest the other. I think that's a phenomenal approach.
I think it is too. You see sometimes professional athletes saying, I take all of the income I get from the team and I set that aside. And then any advertising deals, and I guess you could say this about college sports now too with NIL, that's all set aside. That's all, the money I use to live on, which I think is great. But yeah, I'd like to see a percentage of the amount that your income is saved. I'd also like to see, again, a more variable rate. I wouldn't put it to 1. And by the way, you mentioned something that's fascinating to me, Roxy, when you said that's a reasonable number. We have no idea about the future. Roxy doesn't know. Her future's longer than mine. What rate of return we could expect on anything, right? I mean, we could tell you that actually a diversified portfolio with U.S., international, and leaning to small has made more than 10 over a long period of time. But will it for the next 50, 60, 70 years? Don't know. There's all kinds of people say, oh, you should expect, John Bogle, before he passed away, said expect less from stocks, and then they've way outperformed what he expected. Yeah. So you can't count on a rate of return, I don't think, into the future. What you can count on is making sure you're saving enough, making sure you're properly invested, and making sure that you aren't going to be dipping into that too early, because this is another mistake people make is they forget that, as I say, things come along that can impact your life, whether it be children or homes or other stuff you want to spend the money on. And I am a believer in spending money as you go along. We've talked about that too, not just socking it all away for 30 years. And then I wake up at 65, ready for retirement, and I don't feel like going. I don't feel well enough, et cetera, et cetera. So, Ben, thank you. Great question. Love to hear from you. 855-935-TALK. That's it's so easy. TALK, you could do that. Give us a ring. We'd be happy to talk to you here on Talking Real Money. We'll be right back.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hey, we'd love to hear from you on the program. 855-935-TALK. That's 855-935-TALK. 8255 if that's easier. Tom here, Roxy over there. You know, I ran into some friends this week. Love talking to my friends. They always want to know about money because they know I'm involved in money. And somebody said, you know, things are great. My company stock is doing really well, which caused me to stop and say, wait, are you invested in your company stock? And the answer was, well, yeah. I believe in this company. They're doing great. We have terrific management. Stock price has been going up, et cetera, et cetera. Now, I've said this before. I don't believe in investing in any individual stocks. We don't do it here for our clients. I don't recommend it, even though I was on television for a long period of time talking about individual stocks in the Northwest. I don't do it for a couple of reasons. I don't trust the volatility of them. And you saw it this year where Tesla lost 30% of its value. Apple, great firm, lost 20%. I don't know how much of that is rebounded with the stock market coming back a little bit, but that's significant to see a third of your money gone in a short period of time. The other reason I don't believe in them is the default risk. You know, all companies eventually go away. I mean, even the great ones like Sears and Washington Mutual and Enron, you get the idea here. I mean, things come along, they're great ideas for a while, and there will be one day where people said, remember when Amazon was a really big deal and they used to do all this stuff? Yeah, I do remember that. But here's the reason I really dislike people that invest in their company stock, because you have this bias. You work there. You feel like you know what's going on better than others. You know the management. You trust it. I've worked at the firm for a long time. That's not the way you want to invest. You want to be separated from the things you're invested in, have an arm's length, like, well, I invest in all of these companies because I trust kind of the economy that things will grow. And if they look bad for a while, they'll do better. But when it's stuck with that one firm, and by the way, the other reason I hate it is, you have your employment in that basket today, right? It's already there. You're counting on them to keep paying you, your income. And now you're going to throw your retirement on top of that as well. Well, I don't trust it. I don't believe in it over the long haul. And we've seen many cases where people have had real problems that come as a result of that, right?
Yeah, absolutely. I mean, we get a ton of people who come to us. The smart investors acknowledge that even if they got lucky, which that's really what it is, you got lucky. Nobody can really foresee which company is going to outperform. But even those that come to us that got lucky, they acknowledge that they can't have all their eggs in one basket, especially going into retirement. So we had a case where a client came in and she got real lucky with her Costco stock and her 401k plan, but she was, ready to retire and ready to diversify. And I think it was a really, really smart choice. It's a good topic on behavioral finance.
It's a fascinating thing. Well, we all have a home bias because we are Americans. We live here. We feel like we know how things work better than we would in France, for example, unless it's
Yep.
you, of course, being the Francophile you are. So we trust that. And then it boils down to the fact that, well, I'm in the same town with Boeing. I've seen what great job they do building planes, or I've known Microsoft because I have followed the career of Bill Gates or all these things that or Amazon, et cetera. Costco's a great example, by the way. A lot of people in the Northwest hold Costco stock. It's a great company. I used to interview Jim Senegal, 20 years ago. When they're still up and comer, which I guess they've it's pretty much they've made it. But, you're right. It's still right to diversify in any circumstance that I can see. I can't see any reason. I like what you said about the fact that win was lucky and she was honest about it.
Yeah. I mean, that familiarity bias, I think, is the most common that we see with investors, whether it's owning just domestic stock because it's your country, whether it's, products like you mentioned that you're familiar with, and obviously the company that you work for. It's the most common bias that we see by far. So just being conscious of it is important.
It is indeed. And I will say this too, even if you work there, you don't know more about what's going on there than the people that really study publicly traded companies. And even those people don't do a better job of picking them. And as I mentioned, Warren Buffett, not that long ago said when he's gone, his wife has been told to put it in an index fund, leave it there. Don't mess around with it. Don't try to figure out what the future is going to look like. Buy and hold for the long haul. So yeah, I'm not a fan of individual stocks and really not a fan of when you work at that firm because I think it's a mistrust that should exist. Hey, we'd love to have you be part of the program. Give us a ring, 855-935-8255. That's 855-935-TALK. We will be right back.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hey, welcome back to Talking Real Money. We are here every Saturday live. I think we missed one Christmas day 5-6 years ago or something. So, but otherwise we're here. Tom's here. Don's got the day off. Roxy's joining me in the studio, and we're answering your questions and calls about any and all things money. Yeah, we spend more time on the investing side, but we're happy to take up other topics as well. And here's the phone number. 855-935-TALK. That is 855-935-8255. So give us a ring. And let's go to, well, right next door to Don, maybe looking over the fence, make sure he's okay. Chris joins us from Orlando. How are you, Chris?
Awesome. How are you? Thank you.
Doing great. My pleasure. How can we help you today?
All right. So I'll be 50 years old this year. I have some money set aside that's in like a 4% to 5.25%, just because there are some CDs. And what I'm looking to do is take about $200,000 and invest it in ETFs. I'm not going to need the money for the next 15 years. So I was in between a couple and just wanted your thoughts on it.
Sure, go ahead.
So internationally, I was looking at DFIV. Or VEU. They both seem very good, a little bit different, both international. But one's a little bit more broad, it looks like. But I just
What was the second one? I got DFIV. What was the other one?
Oh, VEU.
And that's Vanguard's. Yeah. Okay. Yeah. These are very different funds. So, the first one is the dimensional fund, the international value. So this is a very small part of the international market. And by the way, it's been the best performing part of, maybe you already know this. It's been the best performing part of the entire globe this year. It's up just looked this up the other day, almost 15% year to date. So it's done very, very well. But still, okay. When you're going to build your portfolio, you really want to have, and the purpose of this money, the 15 years, is going to be for drawing it out when you retire then?
Correct. Yes.
Yeah. Okay. So I would step back then and say, and you've decided to have it all in stocks, or are you going to have any bond part of the portfolio or not?
I'm interested in doing some bonds. I do have some bond funds that I was looking at between, from BND and also an FBND.
Okay.
Those two were the two that stuck out with me.
Yeah. So, okay. But the first decision, Chris, would be to decide what you're going to have in terms of the ratio between stocks and bonds. That would be the first one. It's 15 years and you're okay with risk. Maybe it's 70 or 80% in stocks, the rest of it in bonds. And I love the fact you'd use a total bond kind of product. I think that'd be great. Then you would say, okay, with that 70 or 80% that's going to be in equities, how am I going to build the portfolio? Now, there's a couple of different ways to do this. You could do it very simply with one fund, and if I was picking between them, I could either do VT, which is Vanguard's Total World Fund, or you could do DFAW, which is Dimensional Funds Global Fund, or AVGE, which is the Avantis Global Equity Fund. Any of those three take in all of the stocks, well, not all of them, but basically the global market. With the Dimensional and Avantis products, they're going to lean a little bit, if you will, own more of small and value than the Vanguard products would do. But those would be used on their own. If you said, I'm going to spend a little more time on this, Tom, then would end up using a fund like DFIV, because that should just be a small part of the overall international market. You would want large companies that are growth style. You'd want small companies that are growth and small companies that are value. You want all those different components. What the DFIV is really large value stocks that are international. You'd be ignoring the U.S. market, the S&P 500, but maybe you hold those things in other parts of your portfolio. Would that be true?
Yeah, that's why I was thinking maybe VEU would have a lot of that in it as well. That if I split between them, I might get better coverage.
Mm-hmm. One thing I will say is, going back to whether to use a one fund or multiple funds, sounds like it's going to be taxable money. So I'd actually recommend using multiple funds, which it sounds like that's what you're doing, just because when you do get to retirement, you'll have more funds that you could sell and you'll have a little tax flexibility in terms of what your gains are.
Yeah, that's a great point, by the way. So, yeah, those are two very different funds. One is more of a total international market, and one is more of a value. As you said, maybe you do 2/3 of the total and 1/3 of the value to give yourself more of a value tilt there. Thank you for your call, 855-935-TALK. We'll be right back with more.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to Talking Real Money. Tom Cock here. Don McDonald out for the day. And we'd love to take your questions and calls. Roxy's here with me as well, one of our advisors. You've heard her before on the podcast. First time she's ventured into the studio to do the live radio show. So quiz her a little bit. 855-935-8255 is our telephone number, 855-935-TALK. I'm supposed to say toll free. Like any question, like any call anymore. Anyway, so it's toll free. So, with that, we go back to the phones, venturing north of the border to Ottawa, Canada. And Jeff joins us. Hi, Jeff. How are you?
Good. How are you, Tom? Nice to talk to you again.
Nice to hear from you. Yeah. Nice. Hello. Nice to hear from you. And I got to say, in all honesty, now, I have teased you a bit about the Canada-U.S. thing, but that's disrespectful. I shouldn't have done that, and I'm going to apologize for that because we love you guys. This whole thing has been disturbing because there was a time when I had to learn the Canadian national anthem. I was in the Rotary Club in Bellingham, and we had a lot of visitors from Canada on a regular basis, and so I got to know more people. So anyway, I apologize for that. No insult intended in any way, and we love you and the rest of the Canadians. So please accept my apology.
No, there's no need to apologize, and it's all noise. And now that we've got a new PM, that's I think going to be be effective at dealing and negotiating with Mr. Trump. Everything is going to be fine. So
good.
Yeah, I'll just get to my my question. It's just a general one about ETFs. I think the answer is no, but I'm just wondering if the buying and selling of an ETF affects the price it's traded at, or if it's just the trading of the stocks within the ETF that determines the price. So I guess you could take like VOO, for example. I own it. So all the stocks in the S&P 500.
Yeah. You still there?
Yeah, I'm here.
Okay.
Right, I'm on a remote lake. I'm actually in Ottawa, so I'm hoping the connection's good.
The connection so far has been good. But yeah, your question is when you buy and sell exchange traded funds, does the price change the result? Yeah, because there's going to be a difference between the bid and the ask there. And, you're right. Then there's the question of if I make a large purchase and the ETF has to make a purchase of those stocks, et cetera. Yeah, some of those things could come into play. And we have had questions about this because obviously with a mutual fund, there's only one price every day. That's it. So you don't get this variance of intraday trading, et cetera. Here's the thing about all that, though. Because the money that we manage and the money in my portfolio and the money that Roxy's got invested is for the long haul, I know there are times our trading department during the day will make more trades than others because it's viewed as a better time to do that. I don't know all the hours of the day, et cetera. But I can tell you that I know you're a long-term investor. This is money that you're going to have in the markets for a long time. So looking at all of that is probably not necessary. I guess I'd put it that way. Would you agree with that?
I'd agree. I think ETFs in general is a great choice, but I wouldn't worry too much. I mean, if you are buying, right, and you're buying into the ETF, then it kind of flows through to what the ETF has to do in terms of how they manage it anyways. So, I think it's a little null.
Yeah, I guess maybe I'm like sort of overthinking it a little bit, but I was just like wondering, like I know that like the VO, it's comprised of all the stocks in the S&P 500, but say for instance, if people who own VOO tomorrow, they just started unloading, it wouldn't have an effect on the prices of the stocks within the S&P 500, right?
It would at some point because they'd have to be unloading those. And by the way, there was a piece that Eric Barcelonis wrote last week in Bloomberg talking about bond funds because people have been unloading bonds. Now, I don't know if they were, sort of rebalancing because bonds have been up a little bit and stocks have been down a little bit. I doubt it. I think there were some nerves frayed back to the president and his policies that impacted how much people wanted to buy our debt, et cetera. And there were some people sort of unloading there. And Barcelonis wrote that if that sell-off continued, you might get to the point where some of those major players either have to do a trading halt or they really have to start unloading securities. So yes, all those things would have an impact on the price. But again, I kind of like what you said at the beginning of your discussion there. I think you're overthinking this. I think you're overthinking it. That's really poorly put, but you're worrying about things I don't know that you need to worry about. If I were you, I'd want to make sure I have the right bait for the fish, whether it's fly or whatever in your lake there to make sure you're going to have a good catch before you have to leave.
Yeah, no, I do have a good portfolio. I called, I think a month or so ago about that. I'm confident in my balance and everything, my world exposure. It's just, I'm not so much worried. It's just, I was curious. I was driving up here yesterday and listening to your podcast as I usually do. And the question just sort of popped into my mind, sort of the interrelationship between the ETFs and the actual stocks within it, the effect that the buying and selling of, say, the ETF or the stock within the ETFs would have vice versa. So
I think your thinking is right. Yeah, no, I mean, and there was a time, I believe it was 2013, I think that's the right year, when we had a thing called the flash crash, where the market makers did not step in and prices decreased very rapidly in a short period of time. It was fixed in a relative quick fashion, but that was, I think if you typed in flash crash, you might be able to look that up. So these things have created problems. I think they've worked hard to fix them, or 2010, I guess, was the year. So it wouldn't be something that would be my worry at this point, but your point is legit. Yes. If people sell out of those securities quickly, then other securities have to be sold. And that all, of course, leads to another sort of, as I would say, flash crash situation. Yes.
Okay. Yeah, okay, that's great. Thanks. You're going to have to come up with a nickname for me, so I'm like that Bitcoin Bob fellow.
Yeah, I know.
I will. Regular callers.
I know.
I'm Canadian, so you and Don are going to have to come up with something.
All right. Well, it'll be charitable and it'll be kind. We'll just you can be sure of that. Jeff, thank you very much for calling us. This is
thanks, Tom. Thanks,
you bet.
Roxy.
Have a great time. This is exchange traded funds. Now, for those of you who've been a long time listener, you know that we were slow to adopt them. For the flash crash was one thing going way back to 2010, which doesn't seem that long ago, but it was. And the construction of them is a little different than mutual funds. So we were conservative for that. And we kind of wanted them to get their legs a little bit before we jumped on board. So, but now we're all in because, in fact, we just had the folks from Dimensional here recently, and we were talking with them about when to own mutual funds and when to own exchange traded funds. They were saying always exchange traded funds in taxable accounts because of the tax benefit, but they would still say mutual funds in like IRAs and Roths, which I thought was interesting because I'm like, I think I just use them in every, but they're like, no. So there's still a debate. It's not that clear. But I think for anybody that comes to us now, we're going to put you all in exchange traded funds, correct?
Absolutely. Yeah. And especially in the taxable accounts. The reason for that is the way that it works when they manage the taxes, the capital fund distributions in the ETFs, they can absorb some of that internally so that you as the investor don't get it. So I don't know, mutual funds versus ETFs and retirement accounts, maybe they're more long standing. That's why they said mutual funds, but I think both are great.
All right. Give us a ring. We're happy to talk about any topic. 855-935-TALK. 855-935-8255. We shall return.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hey, thanks for being part of the program. And just really quickly, I want to mention a couple of things. If you'd like some help. Now, one thing we've learned here in the last couple of months is sometimes market volatility can be very upsetting, and you don't understand exactly why your portfolio has gone down a lot. There are a lot of you just invested in the S&P 500, which have had a tougher year than a globally diversified portfolio. There are many of you that just got into technology because this thing has gone up and up and up and up and up. Oh, there's some of you that are just individual stocks because I believed in Tesla or Microsoft doing all this great work with AI, et cetera. So part one of all of this is to really know what you own. Many of you do not. You have a series of funds. You have a bunch of different portfolios, different accounts, et cetera, et cetera. One thing we have done absolutely 100% free with no sales or obligation of any kind is review your overall holdings. We have a wonderful report we do for you. We give it to you. We tell you you really should hold more smaller companies and maybe some value, try some international. Be more diversified. We do that absolutely 100% free. And you get an hour of time with someone like the amazing Roxy too. So you simply go to talkingrealmoney.com, click on Meet an Advisor. Now, as part of that, I'm going to go to Oregon. Oregon, I'm coming for you. May 21st, I'll be down there in our office in Lake Oswego. I already have a couple of appointments. I'm only going to take one more. So if you're in the greater Portland area and you'd like to meet me, I would love to meet you, do the review of your portfolio and talk to one of our planners. That is the 21st of May. And if you want to be that person, the last one, you go to talkingrealmoney.com and click on meet an advisor and just say, I want to meet with Tom. But you do a lot of these meetings. Mm-hmm. What's the biggest mistake you see people making? Tough. I'm putting you on the spot here.
I think being heavily weighted towards large U.S., 100%, without a doubt. That's the most common thing that we're seeing. And this year is a great example of why that isn't always the best choice, because international markets, last time I checked, were like up 10%. So
no, more than that, international value up 14.6.
Yeah. I think the blend altogether is a little bit less, but yeah. So that and some small and, we're seeing less and less of expensive mutual funds, but it's still very, very common that people don't even know what they're paying in terms of their mutual fund or exchange traded fund fees. So it gives you a good outline of what you're paying, what kind of risk you're taking, how diversified you are, and it's really insightful.
It is. And then oftentimes people will say, do I have enough money to retire, Roxy? Is it all there? And you'll say, not if you keep going that landscaping project you got going, Tom, or that trip, or you're going to keep on working. But we touch on that topic a little bit. That's harder, and that would take more of our time. And oftentimes you need to pay us for the real planning part, but we'll answer the question to make sure you're on the right road to getting that fixed. So how do you go about that? Again, and there's no cost or obligation to any of this. We want to help you. We've helped hundreds of people, thousands who've never become our clients, in addition to the podcast, et cetera. So you just go online. It's pretty easy. Go to talkingrealmoney.com, where you can, by the way, listen to more podcasts if you'd like. And you simply click on meet an advisor, fill out a very short form. We will call you back. We'll set up a time. And yeah, sometimes people come to our office in Bellevue. Sometimes we do this on Zoom. Sometimes we just have a phone call and we say, go buy these 3 funds and call me in the morning. So, it's that simple. So take advantage of that. That's really a great offer. We've done this for decades and it's been very, very popular. So again, for that kind of help, go to talkingrealmoney.com, click on meet an advisor. That is talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.